Dear friends, today I'll be sharing on a company in the Dow Jones Index. The Dow Jones Index consists of 30 of the most powerful companies in the USA. There's been a research buying the Dow's worst performing stock has historically generated big returns the following year. And in 2021, that company was Disney, and its share price corrected 14.5% last year. So, will Disney be a star performer in 2022? Well, let's not just take history as a certainty. Let's look at Disney itself as a company to see is it worth my money. We'll be looking into the business of Disney, the industry it is in, the competitive dynamics, the risk, and lastly, the valuation. Of course, at the end, I'll be sharing with you, would I be buying this company myself? So, let's get to the business overview. By 2021 revenue, you can see that the large part of its revenue is made up of linear network. Linear network consists of broadcasting, which has its ABC network station, and cable TV. And the second being is Disney Park. I'm sure all of us has been to Disneyland sometime in our life. And thirdly, is new business segments, DTC or direct to consumer. This is we call a streaming business. Of course, the most famous being Netflix, exemplifying this business. And lastly, content sales and licensing. This is when Disney licenses its intellectual properties to third parties. And if you look at Disney from 2009 to 2020, its net profit has been growing at about 17% per year, a reasonably fast growth rate. Now let's look at the industry overview. Firstly, it's linear network. The linear network within Disney or globally has been a declining business. Right? Because in the past, I'm sure all of us use cable TV a lot. But today, most of us have been migrating over to streaming. And we also watch TV a lot lesser, choosing internet instead. So the peak of this pay TV was actually in 2012 in the USA. In 2012, the number of subscribers was about 120 million subscribers. Today, it stands at about 70 million. Based on the research, it is expected to stabilize at around 50 million subscribers. As you can see from the chart here, from 2016 to 2020, actually the pay TV revenue is declining. However, if you look at Disney itself, it's been holding its ground very well. Its revenue has in fact been very consistent and even has some growth. The reason of it is because Disney was still able to raise its price despite a falling number of subscribers, and hence it's been able to keep its revenue stable. Next, let's look at, I'll say that probably its crown jewel of the future, its direct to consumer business. This business is clearly growing, as you can see from the chart here. As of 2021, Disney accounted for about 25% of the industry market share. And this is actually a very credible, given that Disney is a relative latecomer into this industry. And it's a park business. If you look at it, Disney is definitely very dominant. Now, it's Disneyland, or it's by far the leader among all the theme parks. And within the theme park, the revenue source is largely from the admission fee, followed by sponsorship, parking, food and drinks, etc. As you can see from this chart here. Well, let's next go to the investment analysis. I'll look at two main things. The first thing is the most important when I look at the business. I call it the moats, or I call competitive advantage. Is it able to keep its competitors at bay? That's a very important question. And secondly, let's look at its markets. Can it be growing from here? Moats. What's so powerful about Disney is that it has many powerful intellectual properties. And all these intellectual properties are we are actually very familiar with them. just show you some of them. As you see from here, do you recognize these two characters? Mickey Mouse and Donald Duck. I guess almost nobody in the world would not recognize these two characters. But we know them so well. Next, some of these movies I've been growing up with. Star Wars, X-Men, the Avengers. Until today, they are still very, very popular with people. And it's very, very hard, in my view, to substitute them. Because they are all etched in our memory and we want to follow them. For the younger generation, for those who have kids or the children today, it will be things like Frozen, the new things that will be etching in their memory when they be growing up. So this very powerful intellectual property, which is etched in our childhood memory, are things that's very hard to dislodge. And that makes Disney very powerful, that we keep wanting to go back to them. And the competitor is not able to come into their grounds because of all these intellectual properties. Moreover, for Disney, they have a very powerful ecosystem to be able to monetize and harness their intellectual properties. For example, when Disney acquired Star Wars from Lucasfilm, first, it's able to continue to build more movies on Star Wars, and people will come and watch them. And they also built Star Wars attraction within their Disneyland, and hence this can attract more people to go to Disneyland to visit. And they can also be doing merchandise from their Star Wars intellectual properties. And now, given they have Disney Plus, they can also be putting this movie in their Disney Plus to attract subscribers. So a single intellectual properties can be monetized over so many platforms, and that makes it very profitable for Disney. Next, let's look at markets. Can it be growing? Let's look at, in my view, the crown jewel of the future, which is its streaming business, or its DTC, direct to consumer. Let's look at Netflix. So Netflix took a good 10 years to achieve 100 million subscribers. And now it achieved 200 million subscribers 3 years thereafter. Disney is a relative latecomer. So it started this business in 2020. And in 1 year, it managed to achieve 100 million subscribers. Based on forecasts, by 2024-25, it's going to reach 200 million subscribers, and will be quite on par with Netflix by that time. And as you've seen just now, this is actually a very attractive industry because it's a fast growing. And not only that, it's a very recurrent subscription sort of business, which has we tend to attract very high valuation. Let me just share at this point a bit of difference between Netflix and Disney, which makes me favor Disney more. Okay, how Netflix builds its contents is it builds a lot of new contents, new exciting contents. Some of it will be hit, some of it will be missed. Okay? For Disney, I feel it's a much lower risk. So when it managed to hit a successful IP, or let's say like Star Wars, then it will build its series around Star Wars, more and more series. And hence to me, that is a lower risk way of building successful contents. And if you look at a very important metric, is also the retention rate. Well, it's not just subscribing, but being able to retain their subscribers. For Disney, it's the highest retention rate at around 80%, as you see in this chart here. And that again makes Disney powerful. How about the growth of these segments? Based on the management of Disney, the total addressable markets of this video streaming business is about 1.1 billion subscribers. Just now, as you've seen, Disney has about 100 million, which means it's just scratching the surface. It's at less than 10% of its total addressable markets. This means in this segment, it still has a lot of room to grow. Now, how about its other businesses? Its legacy Disney Park business, its linear network business. Well, to me, I guess those will be at a high single digit to low double digit kind of growth. Because for Disneyland, it's able to raise its price every 2 to 3 years. And hence, it's more than able to offset inflation. So for these businesses, I think it's able to beat inflation with some percentages to spare. So overall, I think Disney is still going to be a reasonably fast-growing company. After looking at the good, let's look at also the risk of investing in Disney. I identified 3 of them. The first risk is that of a prolonged global pandemic. Because one of its business is very susceptible, that being its Disneyland. Its Disneyland business actually went into negative zone during the peak of the COVID. Of course, now it's recovering. But if this pandemic is prolonged, the admission into this park is going to be very restricted. And hence, it's going to take much longer to resume back to its pre-COVID profitability. Secondly, intensifying streaming competition. Because not only Disney is coming on stream, we also have Amazon, Apple also wanting a piece of the pie. However, I put this as a relatively low risk because unlike Disney, which has a very rich library of contents, this newcomer don't really have that. And that gives Disney a big edge. Thirdly, the ability to integrate its business, because Disney has been acquiring new intellectual properties as well, and it needs to integrate all this into its business. So far, it's been pretty successful, and hence I also rate this as a relatively low risk. Let's now look at the valuation, because it's fallen about 15% in 2021. Is it now attractive? How I do this valuation is I assume all its businesses as in 2021, except for its park, because currently it's only a fraction of its pre-COVID business. And if COVID is over, it's likely to resume back to at least its pre-COVID level. And with that valuation, I derive at about a 28 times price earnings ratio. Now, is that cheap? Not really. Before COVID, Disney's price earnings ratio was just below 20. And hence now if you look at it, it's above that price. However, we got to take notes that Disney's business is not exactly as before COVID, because it's got this new business, which I say is highly valued. It's video streaming business, which is very sticky, very recurring. So let's look at another way of valuing Disney by comparing it to its nearest competitor and taking their valuation. So for its video streaming, I take Netflix. Netflix today sells at about 9.8 times price to sales. And if Disney is able to achieve that valuation, this will account for $92 per share. Next, for its park business. Okay, so we assume it's go back to pre-COVID, and we use its nearest competitor, that's Six Flags, which is a pure theme park business. And Six Flags average price earnings ratio is about 18 times. So if you use 18 times on the pre-COVID Disney parks business, that will translate to be about $47 per share. Next, we look at its linear network business, being its broadcasting and also its cable TV, both of which sells at about a forward price earnings of 25-26 times price earnings ratio. And if I translate that into Disney, that will give me about $68 per share. Adding all this together, $92, $47, $68 as per the chart here, it will sum up to $206. Today, Disney is selling for $157, and hence I think Disney is probably at a pretty attractive price. I also do a lower end and upper end comparison just for your estimation. Next, I also want to look a bit of the forecast because, as I say, its DTC, its video streaming business is still at its infancy, and hence it's still loss-making. But let's look forward into 2024 with a few assumptions, which is its park business will grow about 5% at about combating inflation, plus its new business of 3 cruise ship, plus based on the management growth of its video streaming business. And if I base on that, the valuation I'll get is about $250 per share. That represents about a 60% upside from today. Okay, so with all this plus and minus of Disney, would I be putting my money into Disney? The answer is a yes. Okay, so for me, I like Disney, especially given the price has fallen last year. And the price has fallen because it's a new subscriber rate is actually fallen behind the expectation. However, I think this is a temporary thing, and it gives us a temporary discount to be buying into Disney. But personally, I will be buying into Disney. However, what I'm sharing here is really just my own view. You can say it's just for your knowledge, for your entertainment. Before putting your money into this, if you want to get real advice, I think you need to be listening to your financial advisor instead. So please look for your financial advisor if this attracts you and you want to put this into your own portfolio. So I hope you like this discussion today. And till next time, I'll see you again. Bye-bye. If you'd like to be listening regularly to the Grey Rhino YouTube to gain more financial knowledge and also investment wisdom, do subscribe below to the Grey Rhino YouTube channel and remember to turn on your notification.